Okay, let's take a look at multiple choice number 23 on page 364. Number 23 on page 364 says, in its December 31st, 2008 balance sheet, E should report interest receivable of how much? On July 1st of 2008, the East Company purchased as a long-term investment $500,000 in face amount 8% bonds of the Rand Corporation for $461,500 to yield 10% per year. The bonds pay interest semi-annually on January 1st and July 1st. East does not elect the fair value option for reporting the securities. So because they don't elect the fair value option, then you have to follow standard number 115. In the December 31st, 2008 balance sheet, East should report an interest receivable of what? Okay, because it says that they're long-term, basically we are going to then assume that this is going to be held to maturity. Okay, it's going to be held to maturity, in which case you have to do an amortization schedule. So I did the amortization schedule for you. We first start off with July 1st, okay, and everything is blank except for the carrying value, and the carrying value of our investment is $461,500. Then we have to amortize for 1 6-month period because they want to know it as of in its December 31st, 2008 balance sheet, so that's 6 months. And to calculate the interest payment, you take the contract rate, which is 8%, but because it's only 6 months difference here, that would be 4%. 4% times the face amount, which is $500,000. That's the face amount. 4% times 500,000 is going to be 20,000. That's the annuity. That wouldn't change. That happens over and over again. For the interest expense, you take the market rate. The market rate here, it says to yield 10%. So it's 10% per year is the market rate, but since it's 6 months, it's 5%. 5% times the carrying value, so 5% times the $461,500 is going to give us $23,075. Then you just take the mathematical difference between the two, which is the plug, which is $3,075. What do you do with this $3,075? The carrying value always has to approach what is owed. What is owed? The total amount that's owed is going to be $500,000, which is always marches towards what's owed, which is the face amount, which is $500,000. To get from $461 to the $500,000, you have to add the $3,075. So the answer for the carrying value would be $464,575. So they want to know, in its December 31st, 2008 balance sheet, E should report an interest receivable about, what is the interest receivable? Is it $23,075? Wrong. That's not the interest receivable. This I marked as interest expense. Now that's from the point of view of a bond payable. If it's from the point of view of a held to maturity investment in bonds, this would be an interest revenue. It's the same thing, but it's an interest revenue. All right? But that's not what they're asking. What they're asking is for what is the amount of the interest receivable. What is the amount of the interest receivable? Well, that would be the cash that they eventually get, which is the $20,000. Oh, that's just so terrible. So the correct answer is $20,000. Now the journal entry that they would make is that they would credit interest revenue, and they credit, I can't even spell anymore. They credit interest revenue for $23,075. They would debit the interest receivable for the $20,000, and the difference of $3,075, they would just hit debit investment in bond. Now, when you have bonds payable, you have a separate account for discount on bonds payable and premium bonds payable. When you have an investment in a bond, you don't have a separate discount and premium for the investment. You just tack it on right in there. So there's your amounts. And what would happen is that they could ask you from this, what is the amount of the interest revenue? The amount of the interest revenue would be $23,075. What is the carrying value of the bond investment? The carrying value of the bond investment is $464,575, but that's not what they asked. They wanted to know the amount of the interest receivable. This is the interest receivable, which would be eventually the cash payment, which is $20,000. Now remember, the investment in bond is a long-term investment. The interest receivable is a current asset. Long-term asset, current asset. These are two completely different things. They go in two different places on the balance sheet, okay? So the correct answer for number 23 is B, like Barbara. But you still have to be able, when I give you these questions, you have to be able to answer all the questions, okay? And remember, this would be the same thing from the other point of view. you'd have the bonds payable. Remember, this would be an interest expense. This would be an interest payable. This would be the carrying value of the bonds payable. And then you could calculate the ending balance and unamortized discount for this. So remember, you have to do the questions my way. I don't assign that many questions, but you have to do the questions my way. Okay. Now I think what I want to do is I want to take a look at multiple choice number 11 and multiple choice number 12. Let's just review what the fair value option is. If you turn to page 356, then we're going to do these couple multiple choice. On page 356, in the middle of the page, they say item number 2, accounting for bonds. I'm on page 356, item 2, accounting for bonds. As discussed in Module D, standard number 159 provides that a company may elect the fair value option for reporting financial assets and financial liabilities. If the fair value option is elected for a bond, the rules of standard number 157 apply in determining the fair value of the bond. Standard 157 requires that the measurement of the financial liability should include adjustments for non-performance risk, credit risk, or interest-specific credit risk. The election to value a financial liability at fair value should be made on the date the entity initially recognizes the item. Although the fair value option may be made on an instrument-by-instrument basis, it must be applied to the entire instrument. If the fair value option is elected for a financial liability, I'm in the dead center of page 356. If the fair value option is elected for a financial liability, the requirements of APB 21 no longer apply. Therefore, the bond is not reported with a discounted premium. In addition, if the fair value option is elected for a bond, the effective interest method is not required for measuring interest expense. Interest expense may be calculated using various methods, but the company must disclose it in the notes to the financial statements, the manner in which the interest expense was measured. Most people will just use, the cash basis. Whatever the stated rate or coupon rate times the face amount, that would be the amount of the interest expense, and that's the way they would report it. Any gain or loss in revaluing the bond to the fair market value should be included in the income statement for the current period. So that would go in plus other revenues and gains or minus other expenses and losses, the unrealized holding gain or loss. Okay, goes in income from continuing operations. Two methods are allowed for disclosing financial liabilities on the balance sheet. The first method is to disclose the total fair value and non-fair value amounts in the aggregate with a parenthetical disclosure of the amounts measured at fair value. So they have a line item, financial assets or financial liabilities, total amount, the aggregate. And then in parentheses, the fair value amount is this. Or you can do a two-line approach. The second method of disclosure is to present two separate line items to display the fair value and non-fair value carrying amounts separately. So financial assets or financial liabilities, carrying value, financial assets or financial liabilities, fair market value. So it's two separate lines. All right. In addition, the standards require footnote disclosures of the difference between the aggregate fair value and the aggregate unpaid principal balance. If the fair value of a liability is significantly affected by instrument-specific credit risk, disclosures must also indicate the estimated amount of gains and losses from fair value changes that are attributable to the credit risk. If the entity does not elect the fair value, then the bond is recorded at its issuance price, which was the proceeds, and the effective interest method is used to amortize the premium of the discount, which is the old-fashioned way that we've been doing it. Okay? Let's take a look at a couple of multiple-choice questions. Numbers 11 and 12 cover standard number 159. Remember, they have to tell you they elect the fair value option or they choose the fair value election. Okay? On page 362, number 11 says, which one of the following is a true, I'm on page 362, number 11. Which of the following is a true statement for a firm electing the fair value option for valuing its bonds payable? Letter A, the effective interest method of amortization must be used to calculate the interest expense. No. There are at least two methods. You can use the effective method, you can use a straight line method, or, you can just use the cash basis, okay, and just use the stated rate times the face value and calculate your interest expense that way. Whatever it is, you just have to disclose it in the footnotes, all right? You do not have to use the effective interest method. Letter B, the discount or premium is disclosed in the notes to the financial statements. Now, that is false, okay? If you elect the fair value option, there is no discount or premium, okay? Letter C, the fair value of the bond and the principal obligation value must be disclosed. That's true. Let's take a look at letter D. If the fair value option is elected, it must be applied to all bonds. That is false. It can be applied on an instrument by instrument basis. It just has to be applied to the entire instrument, not just a portion of the instrument. So the best answer for number 11 is C. Let's take a look at number 12. Number 12 says, what was the gain or loss that was recognized on the 2009 income statement to report this bond at fair value? I'm looking at number 12. So they want to know the gain or loss on the 2009 income statement to report the bond at fair value. Number 12 says, on January 1st of 2009, the Southern Corporation received $107,720 for a $100,000 face amount, 12% bond, a price that yields 10%. Okay, so 12% bond and a price that yields 10%. The bonds pay interest semi-annually. Southern elects the fair value option for valuing its financial liabilities. On December 31st, 2009, the fair value of the bond is determined to be $106,460. Southern recognized interest expense of $12,000. Now, the way they got the interest expense of $12,000 is they just took the 12%, which is, it was a 12% bond, so the 12% is the contract rate or the stated rate. They multiply the 12% times the $100,000. That gives them the $12,000. So they're basically just using like the cash basis. All right. What was the gain or loss recognized on the 2009 income statement to report the bond at fair value? Well, when they first sold the bond, they sold it for $107,720, and they elected the fair value option at that time, and so that was the fair value of that liability, would be the cash proceeds that they received, $107,720. By the end of the year, they're saying the fair value of the bond is $106,460. So all you would have to do is apply the initial recognition value, which was $107,720, and then the fair market value at the balance sheet date, which is, so it's $107,720, then $106,460, and so you take $107,720 minus $106,460, that's going to give you $1,260, and so that would be an unrealized what? Well, what happens is that you're reducing the liability, so you're debiting the bonds payable to reduce the liability from $107,720 to $106,460, and then you're crediting a gain of $1,260. And this is the journal entry that you would make. Debit bonds payable, credit gain. Okay? And the reason that you have a gain is because your liability has now gotten less. It's decreased. So when they ask in number 12, what was the gain or loss recognized on the 2009 income statement to report this bond at fair value? It would be a $1,260 gain. The correct answer there would be A, $1,260 gain. Where would you report the gain? You would report it in plus other revenues and gains on your multiple step income statement. What value would you report the financial liability at? You report this bonds payable at its fair value, which $106,460 on the balance sheet as of the balance sheet date. Now this has led to some really, really perverse circumstances, because it means that companies who are kind of like going bankrupt and losing their ability to pay, which means their liabilities are going down in value, okay, because people don't think they can pay them. Guess what? They're showing gains on their income statement because the liabilities are going down because they're not able to pay them. It's just incredible. It's a perverse result. But you know, we're not here. We're just here to study the way GAAP really is. Okay, so the correct answer would be 12, which would be A. Okay, so the answer there for 12 is A. All right, there's a couple other things I wanted to point out to you in here. If you take a look at on page 359, let's talk a little bit about convertible bonds, okay, in convertible bonds. On page 359, about one-third of the way down the page, it says item number 6, convertible bonds. It says that bonds are I'm on page 359, item 6. Convertible bonds. Bonds are frequently issued with the right to convert the bonds into common stock. When issued, no value is apportioned to the conversion feature. Two approaches are then possible to account for the bond when they actually convert them. You can value the transaction at the cost or book value of the bonds, or you can value them at fair market value, the market value. Typically, the fair market value would be the fair market value of the stock. Now, if you don't know, if they're both, they say you value them at the market value of the stocks or the bonds, whichever is more reliable. But typically the more reliable one is going to be the market value of the stock. At market, Then they give you the journal entries. At market, assuming market value exceeds book value, just take a look here at these journal entries. But let me tell you something. Nothing can substitute for doing journal entries. Nothing can substitute from doing T accounts. Basically what they're trying to say is that sometimes companies issue bonds that are convertible bonds. Means that the bonds have a conversion feature. The bondholders can exchange the bond into shares of common stock. Now, generally accepted accounting principles say that when you issue convertible bonds, it's just like you're issuing a regular bond, except you stick the word convertible in there. So instead of bonds payable, it's convertible bonds payable. Instead of discount on bonds payable, it's discount on convertible bonds payable. Instead of premium on bonds payable, it's premium on convertible bonds payable. So basically, when you issue a regular bond, so assets equals liabilities plus shareholders' equity. Here's our balance sheet. What's going to happen is that your cash is going to go up and your liabilities is going to go up. It's the same thing if you issue a bond with a conversion feature. Your assets go up, your liabilities go up. Nothing happens to shareholders' equity. The only time something happens to shareholders' equity is when a bondholder actually exchanges their bond in exchange for shares of common stock. Okay? Let's just take a look at a multiple choice question on that. By the way, the only thing that's relevant if you issue convertible bonds would be you have to do some extra footnote disclosures. You have to say, well, we issued some convertible bonds and the bonds are convertible into this number of shares of common stock. It also does affect earnings per share, which I will talk to you about in Module 13 when we discuss shareholders' equity and earnings per share. Let's take a look at a couple of multiple choice questions on this. Multiple choice question number 31 and number 32. Number 31 and number 32, please. Number 31 and 32 are found on pages 364 and 365. Let's take a look at number 32 first. Number 32 on page 365. Number 32 on page 365. On March 31st, 2008, Ashley Company's bondholders exchanged their convertible bonds for common stock. The carrying... Oh, we have to do number 31 first. Sorry, 31 first. Number 31 says, using the book value method. Now, if you use the book value method, no gain or loss is going to be recognized. If you use the fair market value method, where you use either the fair market value of the stock or the fair market value of the bonds, whichever is more readily determinable, there might be a gain or loss when you convert the convertible bonds into shares of common stock. Number 31 says, using the book value method, what amount of additional paid-in capital should York record as a result of this conversion? Number 31 says, on July 1st of 2008, after recording the interest and the amortization, York Company converted $1 million of its 12% convertible bonds into 50,000 shares of $1 par value common stock. On the conversion date, the carrying amount of the bonds was $1,300,000. The market value of the bonds was $1,400,000, and York's common stock was publicly trading at $30 per share. Using the book value method, which means you're just going to do everything at book value, what amount of additional paid-in capital should York record as a result of the conversion? Okay, the book value, the carrying amount of the bonds, which is the carrying value, the book value of the bonds was $1,300,000. So basically, what's going to happen is you're going to remove the bonds payable at the face amount, which was $1 million. Then you're going to remove the premium on the bonds payable, which was $300,000. That's how you got the carrying value of $1,300,000. I need a new pen. Okay, now you're going to issue shares of common stock. I dropped the other pen. You're going to issue common stock. When you issue common stock, it says you're going to issue them into 50,000 shares of $1 par value common stock. So you're going to say 50,000 shares at $1 par. So that's going to be $50,000. Credit common stock. And then what do you usually credit when you issue common stock? You're going to have additional paid-in capital. So additional paid-in capital in excess of par value. Additional paid-in capital in excess of par value. So that would be the balance, which would be $1,250,000. Now remember, when you first issued the bonds, the assets go up and the liabilities go up. Nothing goes to the shareholders' equity. But you do affect shareholders' equity when you convert the bonds into shares of common stock. And what's going to happen is that, in this circumstance, your liabilities are going down, because here's your liabilities as a normal credit balance. And what are you doing with them? You're going to be debiting them. So you're decreasing them and you're crediting your shareholders' equity. So there, you still stay in balance, okay? All right, so let's see if we can answer the question for number 31. It says, using the book value method, what amount of additional paid-in capital should York record as a result of the conversion? You're going to be crediting additional paid-in capital for $1,250,000, and the correct answer there would be B, like Barbara. What if they ask you, by what amount did shareholders' equity increase? If they're asking for by what amount did shareholders' equity increase, both these amounts, which is the $50,000 plus the $1,250,000, which is $1,300,000. But they specifically only wanted the additional paid-in capital. So the correct answer then would be $1,250,000. The correct answer is B, like Barbara. Okay, let's take a look at some more stuff. We're getting towards the end of this. On page 359, they're talking about debt at the very bottom. Item number 7 talks about debt issued with detachable warrants. Now, what is a warrant? A warrant is just like a stock warrant or a stock option. Basically, companies, they're trying to encourage people to buy their bonds, but they don't want to offer them like the market rate of interest. So what they do is they say, well, if you buy the bonds, we'll throw in some stock options too. And they're typically called stock warrants. Now, there's two types of stock warrants. The two types of stock warrants are detachable stock warrants and non-detachable stock warrants. If you have non-detachable stock warrants, the journal entries are very, very similar to when you issue a convertible bond, okay? You don't attribute anything to stockholders' equity until they actually convert the bonds into shares of common stock. However, if you issue bonds with detachable stock warrants, when you issue the bonds, you do have to attribute some of that money towards shareholders' equity. So once again, if we just issue convertible bonds, assets equals liabilities with shareholders' equity. If you issue convertible bonds, your assets are going to go up, your liabilities are going to go up. Nothing happens to shareholders' equity. If you issue bonds with non-detachable stock warrants, it's treated just like the convertible bonds. Your assets are going to go up and your liabilities are going to go up. Nothing happens to shareholders' equity. If you issue bonds with detachable stock warrants, then some of your assets are going to go up, your liabilities are going to go up, and your shareholders' equity is going to go up. But only if you issue bonds with detachable stock warrants. Now, what portion gets attributed to the shareholders' equity? Well, it's typically the fair market value. Sometimes you know the fair market value of the bonds and the fair market value of the detachable warrants, in which case you just prorate them based on the relative fair market values. Sometimes you only know the fair market value of one of those items. If you only know the fair market value of one of those items, you take the fair market value of that, attribute it to that item, and the balance goes to the other item. Let me show you how they can test these in a multiple choice. Let's take a look at multiple choice questions number 35 and 37, please. 35 and 37 are found on page 365. 35 and 37 on page 365. Number 35 says, in its December 31st, 2008 balance sheet, what amount should Fort report as the bonds payable? Remember, you always report bonds payable on your balance sheet at its carrying value, unless you elect the fair value option. If you elect the fair value option under standard number 159, then you have to put it on your balance sheet at fair market value, and the unrealized holding gain or loss goes to income from continuing operations. Number 35 says, on December the 30th of 2008, the Ford Company issued 1,000 of its 8% 10-year $1,000 face value bonds with detachable stock warrants. Okay, this is this case. If it's detachable, remember, it's going to affect shareholders' equity. It will not affect shareholders' equity if it's non-detachable stock warrants. It will not affect stockholders' equity if they just issue convertible bonds. Each bond carries a detachable warrant for one share of Fort's common stock at a specified option price of $25 per share. Immediately after the issuance, the market value of the bonds without the warrants was $1,080,000, and the market value of the warrants was $120,000. In its December 31st, 2008 balance sheet, what amount should Fort report as bonds payable? Well, here it's nice because they give you the fair market value of both the bonds and the fair market value of the warrants. So you could just do a relative fair market value and prorate what portion goes to the liability and what portion goes over to shareholders' equity. Okay, so So let's see what happens. So on December 30th of 2008, Ford Company issues 1,000 of its 8% 10-year $1,000 face value bonds with detachable stock warrants, and they issue that at par. That means the total amount of cash they got was $1 million. It's 1,000 times 1,000. 1,000 bonds times $1,000 each. They got $1 million, and you have to take the $1 million and attribute some to the liabilities and some to the shareholders' equity. So how do we do that? We do it based on their relative fair market values. They said that immediately after the issuance, the market value of the bonds without the warrants was $1,080,000. Okay. And the market value of the warrants was $120,000. Okay. Okay. In the December 31st, 2008 balance sheet, what amount should Ford report as bonds payable? Well, what I can do is I can create a ratio. If I add these together, $1,080,000 plus $120,000, that is $1,200,000. So this becomes $1,080,000 over $1,200,000 and $120,000 over $1,200,000, and that becomes a ratio of 90% and 10%, because I know this is 10%, so I assume that the other part's 90%. Okay, so then 10% of the cash will go to the liabilities, which would be $900,000. 90% of the cash would go to the liabilities, which is $900,000, and 10% of the cash would go to shareholders' equity, which would be $100,000, because you prorate it based on their relative. These were their relative fair market values. And remember, the way I got the $1,200,000 is I took the $1,080,000, which is the fair market value of the bonds, plus $120,000, which is the fair market value of the warrants, add them together, and I created a ratio. All right, so this is 90%, 10%. So 90% of the proceeds go here. 10% of the proceeds go here. Now, what would the journal entry look like? Well, since the bonds are a carrying value of $900,000, then I know then if I'm going to debit cash for the $1 million, I'm going to have to credit bonds payable. Remember, that's always at the face amount, which is $1 million, and then I'm going to have a discount on bonds payable for $100,000, because the $1 million minus $100,000 is going to give me the $900,000. Okay. Then I'm going to have to credit additional paid-in capital from warrants for the other $100,000, which is 10%. All right, 10%. All right, of the total proceeds I got, which was $1 million. So this is a journal entry you would make. You would debit cash for $1 million because they sold at par. Credit bonds payable at the face amount for $1 million. Debit discount on bonds payable for $100,000. The $1 million minus $100,000 gives you the $900,000 that you attribute to the liability. Then you would credit additional paid-in capital for $100,000 for 10% of the proceeds, which is the $100,000, which is the 10% here of the proceeds. Okay, so let's answer the question number 35. In its December 31st, 2008 balance sheet, what amount should Ford report as bonds payable? They should report bonds payable at $900,000. It's $1 million minus $100,000. It's 90% of the total proceeds, which would be attributed to the liabilities. So the correct answer then would be C. By the way, what is answer A? The correct answer is C, the carrying value of the bonds. Answer A is the total proceeds that you receive. Answer A would be the proceeds. Okay, let's take a look at number 37. Now, unlike number 35 gave you the fair market value of both. In number 37, they only give you the fair market value of one of them. If you get the fair market value of just one of them, you attribute the entire fair market value to that item, and the other one is just the balance of whatever's left. Number 37 says, by what amount should the bond issue proceeds increase stockholders' equity? On March the 1st of 2008, the Evan Corporation issued $500,000 of 10% non-convertible bonds at 103. Okay, these were due on February 28th of 2018. Each $1,000 bond was issued with 30 detachable stock warrants, each of which entitled the holder to purchase for $50 one share of Evans' $25 par common stock. On March 1st, 2008, the market price of each warrant was $4. By what amount should the bond issue proceeds increase stockholders' equity? Okay, they're giving you the fair market value of the warrants, but they do not give you the fair market value of the bonds. So if they don't give you the fair market value of the bonds, you just have to take whatever's the fair market value of the warrants, attribute that to shareholders' equity, and whatever's left goes to the liabilities portion. All right, let's see what we can do with that. Folks, you can never go wrong by doing a journal entry. You can never go wrong by thinking about things in terms of the financial statements, like my balance sheet here. You could never go wrong by doing T accounts. Okay. All right. On March 1st, 2008, Evan issued $500,000 of its 10% non-convertible bonds at 103. Okay, so $500,000, okay, times 103% is going to be $515. We got cash of $515,000. Those are my assets. All right. Then they said that each $1,000 bond, so there's 500 $1,000 bonds because the total face value is $500,000. Each $1,000 bond, so there's 500 bonds, was issued with 30 detachable stock warrants, each of which entitled the holder to purchase for $50 one share of Evans' $25 par common stock. On March 1st, 2008, the market price of each warrant was $4. Okay, so we had 500 bonds, and it says that each $1,000 bond was issued with 30 detachable warrants. So times 30 warrants per bond. And then it says on March 1st, 2008, the market price with each warrant was $4 times $4 per warrant. So I just take out my calculator and I say 500 times 30 times 4. It gives me 60,000. So what would be attributed to shareholders' equity? 60,000. And the balance would go to liabilities. So 515 minus 60 gives me 455,000, which go to the liabilities. Now let me tell you how the journal entry would look. You would debit cash for 515,000. You would credit bonds payable, always credit bonds payable at the face amount, which is 500,000. Now they're saying that the bonds payable, the liabilities, should really be 455, the carrying value. So that means there must be a discount associated of 45,000, because 500 minus 45 is 455. And then you have the shareholders' equity. That would be additional paid-in capital from warrants, and you credit additional paid-in capital from warrants for 60,000. So they want to know, in number 37, by what amount should the bond issue proceeds increase stockholders' equity? Well, you would increase stockholders' equity by the $60,000. There's a credit to additional paid-in capital from warrants for $60,000. The correct answer is D, like David. By the way, what is answer C? Answer C is the amount of the discount on bonds payable. They could also ask you, what is the carrying value of the bonds payable? The carrying value of the bonds payable would be bonds payable at the face amount, which is 500,000, minus a discount on bonds payable, which is 45,000, which gives you the bonds payable at the carrying value at 455,000. So it could ask you, what's the carrying value? There's the carrying value, the 455. They could also ask you what's the ending balance of the discount account, which is 45,000. But here they ask you for what you attribute to additional paid-in capital, which is shareholders' equity. So the correct answer is 60,000. So the best answer is D, like David. But remember, you have to solve these questions my way. You have to do the journal entries. You have to understand what goes to the liability, what goes to shareholders' equity. Where does additional paid-in capital go? That goes as part of shareholders' equity. All right? It goes preferred stock, par value, common stock, par value, then additional paid-in capital in excess of par. That's how it's reported in the shareholders' equity section of the balance sheet. Where do the bonds payable get reported? The bonds payable at the carrying value get reported in the long-term liabilities, right? Okay. One more issue, and then we are done with this. And then I wanted to point out to you a simulation. I'm not going to do the simulation because it is probable that they might ask a simulation. So what I want you to do is I just want you to solve the simulation, okay? But I'm going to show some other simulations for other types of topics because I think the simulation is rather straightforward in here. But if you take a look at the very back, on page 360, we talk about the extinguishment of debt. On page 360, the extinguishment of debt. Okay. Basically, what I want you to do is just take a look at the journal entry, which is 2/3 the way down on page 360. The early extinguishment of debt, the last sentence says that the early extinguishment of debt may be considered extraordinary for treatment. Okay, the only time the extinguishment of debt is considered to be extraordinary if it's both unusual and infrequent. Otherwise, it's not treated as extraordinary; it's ordinary. So, extinguishing debt is rarely, rarely extraordinary. And I would always treat it as ordinary unless you tell it otherwise. Okay, you're told otherwise on the exam. But basically, this is a journal entry that you have to make when you extinguish your debt. The best way to do it is to always learn it through a journal entry. Remember, you're taking off your bonds. Bonds payable has a normal balance of credit. To remove it, you would debit it. Discount on bonds payable, a contra liability account, has a normal balance of debit. To remove it, you would credit it. Premium on bonds payable is an adjunct liability account. The normal balance is credit. To remove it, you would debit it. Bond issuance costs are deferred charge, has a normal balance of debit. To remove it, you would credit it. Okay, and then usually they say that you purchase them at 99, or you purchase them at 103. That's the amount of the cash that you're paying out. Okay, you always remove then your bonds payable, and then you would plug any gain or loss in order to make the journal entry balance. The best way to do this is to do this using a multiple choice question. Let's take a look at multiple choice question number 40. Multiple choice question number 40 is found on page 365. Number 40 on page 365 says, at June 30th, 2008, what amount should King recognize as gain before income taxes on the redemption of bonds? So they're telling you that there's a gain on redemption. So they're extinguishing the debt early. Number 40 on page 365 says, on June 30th of 2008, the King Company has outstanding 9% $5 million face value bonds which mature in June 30th, 2013. Interest is payable semi-annually every June 30th and December 31st. King did not elect the fair value option for reporting its financial liabilities. On June the 30th, 2008, after the amortization was recorded for the period, the unamortized bond premium and bond issue costs were $30,000 for the premium and $50,000 for the bond issue costs, respectively. On that date, King acquired all its outstanding bonds on the open market at 98 and retired them. At June 30th of 2008, what amount should King recognize as gain before income taxes on the redemption of the bonds? Okay. The best way to do this is to always do this through a journal entry. To remove the bonds. So, they had outstanding 9% $5 million bonds, so let's remove the bonds. Bonds payable have a normal balance of credit. To remove it, you would debit it. So debit the bonds payable at the face amount, which is $5 million. We also had some unamortized premium that's left over. The premium on bonds payable has a normal balance of credit. To remove it from our books, I would debit it. So I would debit the premium on bonds payable, and that's for $30,000. Then they also told us we had some unamortized bond issue costs, which are $50,000. Bond issue costs are deferred charge. They have a normal balance of debit. So to remove them, you would credit it. So credit the bond issue costs for $50,000. Then they tell us that we acquired all the outstanding bonds on the open market at 98. This would be 98% of their face amount. And so you'd credit cash, and that would be 98% times the $5 million. So 98% times the $5 million is going to give you $4,900,000. So let's see so far. So far I have debited my bonds payable for $5 million, debited my premium bonds payable for $30,000. I'll credit the bond issue cost for $50,000, credit the cash for $4,950,000. So $4,950,000 minus $5,030,000 is a difference of $80,000. So then I would plug my gain to make this balance, and that's a plug of $80,000. Okay, so let's answer this question. At June 30th, 2008, what amount should King recognize as gain before income taxes on the redemption of bonds? The answer would be $80,000. So the correct answer there would be B, like Barbara. Where would this gain be reported? Well, do not treat it as an extraordinary gain or loss unless they tell you it's both unusual and infrequent, because they didn't tell you that. This is treated as part of income from continuing operations, so that gain would be shown in plus other revenues and gains. Okay. Now there is a simulation. The simulation is found it starts at the bottom, starts on page 367. Now let me just give you a few pointers on what's different about this problem. Okay, they could ask a simulation with an amortization schedule. Okay, they could ask that. Bonds, however, it's very mature, okay, which means that it's an older type of problem if they could ask it. They could ask it, okay, I'm going to assign it to you. I want you to do the concepts, I want you to do the bond valuation, the amortization schedule, and the journal entries. Those are the only parts that I want you to do. The only thing that's tricky about this is that it is because it is a semi-annual bond. If you look at the top of page 367, I just want to go over some of the facts with you to give you some pointers. At the top of page 367, it says on January 2nd of 2008, the Parker Company issues 6% bonds. It has a face value of $400,000 when the market interest rate is 8%. Okay, now you automatically know that this is going to be issued at a discount. And the reason is because they're only paying 6%, but the market is paying 8%. Nobody's going to want 6% bonds when they can get 8%, so it's going to be issued at a discount. The bonds are due in 10 years, and they pay interest every June 30th and December 31st. That means it's a semi-annual bond. So remember to take your interest rates and divide the interest rates by 2. Okay? Also, it says they do not elect the fair value option for reporting their financial liabilities. Because they do not elect the fair value option, they're going to have to do an amortization schedule. Now, if you turn to page 368, on page 368, they give you a bunch of amortization schedules. In the middle of the page, and they also give you some present value tables. They give you the present value of the ordinary annuity of $1. Remember, you only use an annuity when you have a stream of equal payments, so use that for the interest payments. And then you have the present value of $1. The present value of $1 you'll use for the amount of the principal. Okay, always remember, when you use the present value tables, you must always use the market rate of interest. And because this happens to be a semi-annual bond, and they're paying this every 6 months, you're always going to use the market rate of interest, which is 8%. Because it's semi-annual, you're going to use 4%. Notice that they give you lots of different columns of percentages to hang you with. Okay. Next thing that I want to point out to you is that you always want to make sure that you always double the number of periods. Even though this bond is for 10 years, because it's semi-annual, it's not 10 years, it's 20 periods, because it's every 6 months, so they pay interest 20 times, okay? Now, this amortization schedule, if you look under the tab that says amortization schedule, it looks a little bit different because there's one extra column. The extra column is a column that says discount on bonds payable. All the discount on bonds payable is it's just the difference between the face amount and the carrying value of the bond. So it's one extra element. You can actually fill that in the last. Okay. Now the solution for this is found on pages 377 to 378. It's a very, very good solution. I'm really happy with this problem. Okay. So I think what you can do is you can solve this one on your own. They want you to first calculate the valuation of the bonds. They want you to do the amortization schedule, and then they want you to do a couple of journal entries. It's a very, very good solution. Please do this problem, as well as do the concepts, which are on page 367. I also assigned the concept section, which basically talks about what are pro forma journal entries, and they do a really, really good job with the solution with the pro forma journal entries under the concepts. I want you to do this. Please do this on your own, and then I will see you again in Module 11C. Remember, whenever you check for bonds payable, always check to see whether they elect the fair value option or they do not elect the fair value option under standard number 159. Same thing goes for bonds payable as investment in bonds, okay? And I'll see you in Module 11C.